That's right.
It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 of a percentage point and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet.
Just then.
So for more on all of this, we're going to bring in Frances Stacy. She is the Director of Portfolio Strategy at Optimal Capital. Thank you so much for joining us. All right, so we're expecting a rate hike from the Federal Reserve. How will that impact regular Americans in the short term and the long term?
Okay, so regular Americans, we have to divide regular Americans, as we know, into two groups. We have to divide them into a group that has assets. I think, there's some talk this morning that if the Fed raises 75 bips, that the market's going to rally on that news. I don't know why that would occur necessarily. If they
The United States Federal Reserve Bank has delivered its biggest interest rate rise in almost 3 decades after confirming a 0.75% rise. After a 2-day meeting, the central bank increased its short-term policy rate by 0.75%. That's the largest hike since 1994. Analysts project rates will continue to climb beyond 3% by the end of the year, which would be the highest level since 2008. The Federal Reserve Chair, Jerome Powell, says he intends to increase rates in order to bring down those inflationary prices.
10 seconds later.
President of the Federal Reserve Bank of Atlanta, Dennis Lockhart. Dennis, it's great to see you. Thanks so much for joining us.
Thank you.
So let's just start with the Fed's decision today, because you've been in that room before. You've been forced to make those types of tough decisions. What's your reaction to the 75 basis point hike?
Well, I think it shows very strong commitment to tame inflation. Earlier this week, if you'd asked me, I would have expected 50 basis points, not 75. The Fed tends to operate in a steady, deliberate manner, and they had signaled 50 basis points so strongly that I opted for 50. Clearly, the 75 basis point move shows that they think the situation requires aggressive action and a faster timeline. And I think we should all be comfortable with 50. They are prepared to take, with 75, they're prepared to take the risk that this surprises markets. And as you pointed out a few minutes ago, the initial reaction is not dramatic, so I think this is probably a very good move on their part.
Yeah, appears to have been baked in here to the markets. What do you think really shifted the Fed's thinking? Was it that CPI of 8.6%, or was that combined with the consumer sentiment at an all-time low?
Certainly the news last week probably weighed heavily on their thinking. That you had both the consumer sentiment number, which is related to the risk that expectations become unanchored, as well as the CPI numbers last week. And, I think they looked at all of that and they said, we just have to be aggressive because the situation is not improving. It's plateaued. It's not accelerating, but the inflation rate is not coming down.
Where does the policy go from here? Obviously, you have this 75 basis point hike, but you also have, of course, the tightening of the balance sheets. If you could look through your crystal ball, how do you see the Fed proceeding from this point? And what would you do if you were in their shoes?
Well, I would interpret the 75 basis point move today as continuing to put the balance sheet policy in the background and to keep it on autopilot. They did have the option of announcing some kind of a change in the pace of running down the balance sheet. They didn't do that, and I think that's because they really don't want to change, particularly so early, that policy. So the interest rate, the policy rate is the main event. It will continue to be. I think it raises the question, do we see 75 in July or even possibly in September? That remains to be seen. I think the press conference today will give us a better indication of what the thinking of the committee is.
Dennis, what do you think is critical for the Fed, for Jay Powell to convey during that press conference? Because we heard from a number of guests leading up to this decision that the Fed's messaging at this point can be thought of as even more critical.
I think he will repeat the whatever it takes mantra that he's been using, and probably almost pound his fist rhetorically behind that point that the Fed will step up to this challenge. Even as an earlier speaker pointed out, there are multiple causes of this inflation. Some of the root causes are not easily addressable with monetary policy, but I don't think there's any question the Fed is going to step up and do everything it can to bring that inflation rate down near 2%.
And Dennis, these are unusual times in which friends who usually only ask me about Yankees and Red Sox standings are watching Fed meetings, are worried about hearing this number, first biggest rate hike since 1994, saying, I thought this economy was healthy. That number scares them. What do you say